Good afternoon. Welcome to the latest edition of MEED Live and our series of webinars on the impact of COVID-19 on business in the Middle East and North Africa. I hope that you are all well and that you're all safe. And to everyone who is observing Ramadan Kareem, Salam Alaikum, and thank you for joining us today. We've got a very strong program of content today. We're going to summarize, go through the main news events of the last 7 days that affect business across the region, and then we're going to have a special focus on the real estate and property market in Dubai, and particularly looking at some of the issues around Expo and the impact of the current crisis, but also the previous situation in the market. If we could go to the next slide, please, Nabil. Now, the content from today is being brought to you by, from across the MEED team. We have two core teams at MEED. We have MEED.com, the journalists providing news and analysis and commentary, and we have the MEED Projects data business tracking the projects market across the region. And you can see on the slide in front of you, if you're not a subscriber currently, you can find out more details by using those links. I do recommend both services for anyone doing business in the region, particularly at this current time, and we'll make reference throughout the show to both of these. Next slide, please, Nabil. Okay, so the program for today's webinar, we're going to start off with the usual format. We will look at some of the update data on coronavirus cases and the fatality numbers across the MENA region. We will then have a quick look at some of the government measures and responses to that. I think we've entered a new phase. We're now beginning to see the focus on lifting the lockdowns. I think that's quite a significant change of phase. After that, we will briefly look at the oil markets after all the turbulence of last week, and then I will hand over to Ed James from MEED Projects, who will provide quite a detailed review of particularly the UAE construction project market. A quick news review will follow. We're going to look at a couple of stories from the week, the rising influence of Chinese companies in the region, and then I'll look at the aviation sector. And then at around 1:25, maybe half past, we'll move on to our special section looking at Dubai real estate. If we could go to the next slide, please, Nabil. So this is today's panel. We have 4 representatives from across the MEED team, Ed, Neha, Colin, and myself. But we have a very special guest joining us. I'm delighted that Murray Strang, who is the head of Dubai for Savills. Savills is one of the biggest property consultants in the world, and a big presence across the GCC and the MENA region. Murray himself has been in this region for about 12 years, mostly in the UAE, split between Abu Dhabi and Dubai. He's on the Savills board for the MENA region, and he's, in particular, he's the capital market specialist at Savills. So many years of experience, and I know from talking to Murray previously, he's got very deep understanding of the trends in the property sector in the UAE and Dubai particularly. So thank you to Murray and to Savills for joining us today. Next slide, please, Nabil. Okay, so just before we get into the meat of today's program, MEED and MEED Projects together are providing a constant flow of news and comment and data about the impact of COVID-19 in the Middle East, in addition to all the regular stuff. These 3 links will take you to the most common stuff. So on the left, we have the daily updates on MEED.com that Neha is providing. In the middle, we have executive briefing documents, which are PDF reports that Ed provides twice a week with data, not just from the region, some global information as well. And then on the right, we have on MEED.com, there is a dedicated channel for all our news and coverage of COVID-19 in the Middle East. So if you're keeping on top of this stuff, which I guess most people are, those are the 3 good links to follow. Next slide, please, Nabil. Okay, so we now have, this was data as of yesterday, 57,000 cases of COVID-19 confirmed across the MENA region. That's a 25% rise week on week. So we're still seeing strong rise in numbers. It's actually the rate of increase in cases has slowed a little bit compared to the previous week. I think it was around 30%. 7,176 deaths, that's a 13% increase week on week. I think across the region, whilst we are seeing a slowdown in the rate of increase, in the GCC, we're still seeing a much steeper rise in cases and deaths. 68% increase in cases of COVID-19 in the GCC in the past 7 days. So that's just under 50,000 cases as of yesterday, and about 276 confirmed fatalities as a result, which is a 55% increase. So we are seeing a steady, well, quite a strong rise. I think largely it's linear in its acceleration, linear in its rise rather than exponential. And there perhaps is a sign that the rate of increase in death is slowing, even though it's still increasing at a rapid rate. Saudi Arabia seems to be showing the fastest acceleration in death in the GCC region. Iran, of course, remains the worst affected market in terms of numbers and economic impact in the region. Okay, next slide, please, Nabil. So this slide is summarising some of the key, some of the measures introduced in response, the government measures introduced in response to the health crisis. I think that I'm not going to read through each point. That there is a trend, though. I think we've come to a new phase, and that is the getting out of the lockdowns, and we're starting to see restrictions being eased very carefully across the region. So in Saudi Arabia, in the UAE, we've seen retail outlets and commercial premises having restrictions lifted with safety measures still in place. In Kuwait and Oman, restrictions lifted on particular types of business, automotive businesses, quarrying businesses. So we're seeing that, and I think we're now shifting to a new phase. There's going to be a couple of weeks probably where we do this gradually and then see how it goes. But I think it's time to start thinking about how do we get back to work and back to the office. Iran, of course, is on a slightly different trajectory, and there's talks or reports of plans to divide Iran into different coloured zones according to the level of severity and activities to be restricted accordingly. And then in Egypt, which is facing a lot of financial pressures, obviously, have been going on for some time, it's approached the IMF for another financial package to support its economy. Next slide, please, Nabil. So we had quite an interesting report from the IMF that was published this week. It just pulls together the level of some data and the level of stimulus spending and fiscal support measures taken by governments across the MENA region. The summary headlines are $64 billion worth of stimulus, fiscal stimulus and support spending has been announced or committed by the 12 countries in the MENA region that were covered by this IMF report. That represents about 2.7% of GDP. And that has mostly been delivered through the central banks, either through stimulus spending or some form of monetary easing, you know, the cutting of interest rates. We have this combination of lowered interest rates, which have been different in each market, but between 1 to 2% across the region, and various stimulus spending measures. In certain countries, in the UAE, Morocco, Jordan, Qatar, Saudi Arabia, Tunisia, actually, their stimulus measures, their fiscal support measures are a higher level, about 3.4% of GDP in average. Those numbers compared to the rest of the world in that the developing world economies tend to be in that 2 to 3% of GDP range for stimulus activities, and the advanced economies slightly higher, 3 to 4%. And I think the split within the region probably reflects that. So the region is on a par with what's going on elsewhere. But the IMF did sort of single out, praise the speed of the response of central banks and governments in the region when the crisis broke. The slides there, maybe the data on the side is perhaps a little bit difficult to read on this slide, and we will share the slide with people afterwards. But if you want to go to the story on meed.com, there's a link in the bottom corner of the slide that will take you there. Okay, next slide, Nabil. So just a quick one on oil prices. So obviously there was a lot of talk about the negative prices last week of WTI, the American benchmark crude oil. And you can see on the bottom left-hand corner, that's the past 7 days of WTI, and you can see that dip. I think it was last Wednesday when the futures contracts were due to be completed, and people were offloading them for cash, and so we saw the negative prices. It's been steadier this week, about $12.7 a barrel, but we're coming up, you know, people are now looking at the June futures contract, and there is still a lack of storage debate and an oversupply globally, and so concerns that we will see another dip, and you know, for the second time in history, into negative territory, and so measures are being taken to try and avoid that. On the Brent crude side, the top left-hand corner, the past 7 days, we can see it's a bit more volatile, but we're at about $20 a barrel, which is historically very low for Brent crude. And on the right-hand side, on that larger graph, that gives you a 6-year, five and a bit year timeline of the trajectory of Brent crude. And we can see on the right-hand end of that graph, we've slumped right down to $20 a barrel, $20.5 a barrel yesterday. I've sort of annotated that graph with some of the events that have triggered some of the peaks and troughs. But the red dotted line, at the start of this year, most people were forecasting Brent crude or the oil prices to average around $60 a barrel through 2020. Budgets from most governments across the region were set at oil being between about $50 to $70 a barrel, maybe $80 a barrel. But that gives you an indication of just how far below the planned expectation we are. So $60 a barrel was the general approximate consensus forecast for oil prices in 2020, and we're now right down at $20 a barrel. If people are talking about, the IMF in particular, we're talking about a recovery in the second half of the year, with oil averaging $35 a barrel, according to its forecast for the full year. So way below the forecast at the start of the year, that red dotted line, and certainly below everyone's budget break-even point. So clearly the consequences of that are going to be fiscal measures to cut spending and to be more cautious and to borrow more and draw down on reserves more. So it's a story that's been covered many times. We'll just skip through that. I just thought after last week's volatility, it would be good to just sort of get a sense of where we are this week. Okay, so the next slide, please, Nabil. Right, I'm going to hand over to Ed. Ed James is the Director of Content and Analysis at MEED Projects, and he's going to give us a few slides and update us on the projects market in the region. Over to you, Ed.
Thank you, Richard, and good afternoon, everyone. It's good to be back on the weekly webinar program. So over the next 5 minutes or so, I'll just be going through a quick analysis of the UAE projects market in particular, particularly within the context of the real estate sector discussion we're going to be having later. So as you can see on this graph, taken from MEED Projects, you can see that in 2019, the value of projects overall in the region was pretty much flat year on year, 2018 at just $102 billion. But the most pertinent aspect of this data, I guess, is the fact that Saudi Arabia certainly grew last year, but we also saw for the first time in many years a very sharp fall in contracts awarded in the UAE to just $30.6 billion, a big fall from nearly $50 billion the year before. And a lot of that, of course, was due to the slowdown in new projects coming up in construction real estate in Dubai in particular. So we go to the next slide, please, where we can see this in more detail. So here we have both Dubai and Abu Dhabi contract awards between 2006 and 19 in terms of construction sector contracts. And you can see here how Dubai, of course, went through a boom before 2009. It was then taken over by Abu Dhabi in 2009 to 11 period before Dubai overtook again in that period 2015 to 2018. You can see here that in 2017, Dubai had $30 billion of contract awards, and since then it's been declining last year to hit just $15 billion. So Abu Dhabi and Dubai now are very close together in terms of overall award activity, but you can see that Dubai projects market has been falling quite rapidly in the last few years. Go to the next slide, please. And then taking into consideration now the first quarter contract awards and comparing them with previous years, this is for UAE, you can see here that in the first quarter of this year, just less than $2.5 billion worth of construction contracts were awarded in the UAE, compared with more than $6 billion in 2019 and nearly $8 billion in 2018. So we've had a very poor first quarter. Of course, we've had coronavirus impact, but I don't believe that's the only factor impacting the market. There's clearly been a downturn, as we've seen in previous slides, prior to the coronavirus, of lower project spending in the UAE as a whole, and particularly in the construction sector. And that has been accentuated by the figures for the first quarter of 2020. Here's just what projects have been awarded in the last few months. As you can see, with the exception of the Innovation Hub and Academic Campus awarded to the Malaysian company Serba a couple of weeks ago, the other contracts are fairly small in comparison. We haven't seen the type of activities levels that we've seen in previous years. You can see here a selection of deals like the new traders market, for example, the long-awaited Wonderland development on the shores of the creek, the Breeze Apartments for Emaar, but otherwise contract activity levels have been pretty slack in the first quarter, which again points to a slowdown in new supply coming to the market. And finally, okay, let's looking forward. What are the projects currently in tender, out to bid, which we could feasibly be awarded this year, to provide some indication of what's going to happen? Well, we've got the long-running Dubai Creek Tower project, which we're still waiting for an award from Emaar, the tallest tower in the world. We've got the Al Jerf development. We've got the MGM Bellagio Resort Hotel project in Dubai. We've got further developments in Jewel the Creek, and more projects in the Lagoons district in Abu Dhabi. So there's still a fairly large pipeline of projects coming up in tender. Whether or not all of these will be awarded now due to the coronavirus is unclear. Nonetheless, there's still a fairly healthy pipeline of projects. We'll just have to wait and see now how these will proceed, and whether we'll see a continuing of the slowdown we saw in the first quarter, or whether the market will eventually pick up once the pandemic is over. That's all for me for now. I'll be happy to take any questions you might have later. Thank you very much.
Okay, Nabil, if we could just go back to a couple of Ed's, 2 slides back on Ed's presentation, the projects awarded slide in Q1. This slide, yes. Ed, if I could just, and I should say before I ask you a question, actually, if anyone wants to submit some questions for Ed or any of the panelists on any of the topics we're covering, please use the button at the bottom of your screen, the Q&A button, and you can send in a question, and we will do our best to give you a helpful answer. And Ed will be around for the whole broadcast as well. And I think actually the slides that Ed showed about the value of awards made in UAE construction in Q1 is pertinent to the things that Murray will talk about from Savills later on. But Ed, if I can just ask on this slide, it looks to me like a lot of the contracts that were awarded in Q1 have got relatively low values in terms of contract award values. Does that tell us something about, we might expect to see the bigger value, the bigger ticket schemes will be more likely to be delayed or put under question? Because on your next slide about the stuff that's under tender, I think there were a couple of projects at the top that were fairly large value. So can we read anything into this, do you think?
Yeah, I mean, I think, well, I mean, it's both an indication. It's both an indication of the COVID-19 pandemic and the situation currently, but I think it's also the result of quite considerable oversupply of property and a lack of general demand in general in the UAE. That has, following the establishment of the committee last year, set up to control the supply of new property into the market. I think it's also just a reflection of the fact that there are fewer projects coming to the market, and you know,
Yeah.
we're seeing with the larger projects going, you know, they come with more risk, especially you know, given the lower demand, and so it's no surprise really that it's the smaller deals, the smaller jobs and projects that have been awarded in the first quarter, and I would expect that trend to continue. And really, I think the larger the project, the higher the risk and the more the delay, which is what I think we can read into this.
Okay, thank you. And I've got a question here for you that's, that has been submitted whilst you were talking. There seems that, so clients and developers, our clients and developers are awarding major contracts in Saudi and the UAE. So your slide is talking about the UAE. The question is that there seems to be a high amount of tendering activity, but close to nil contract awards. So would you say that describes what you're seeing?
Yeah, I mean that's right. Tendering is still tenders are still going out. Bids are still being submitted for projects. At the end of the day, it doesn't really cost clients that much to issue tenders. It can be a useful way of getting prices and gauging the market, understanding how much it's going to cost before making a decision. So that's something that's going to continue. I guess the key issue, as highlighted in the question, is the fact that they're not moving to awards. And this is particularly the case, I think, with government-funded contracts, say in Saudi Arabia, where the funding now has been put on hold. Government ministries have been told to cut back on spending. And so projects which were originally budgeted may now have to be put to one side, particularly if they're not considered a priority. And this goes back to previous comments from earlier webinars, is that, you know, when we're looking at future projects, it's going to be those social infrastructure schemes, the affordable housing, the education and healthcare projects, which are probably going to get the priority in the reduced budgets.
Yeah. Okay. Thank you. Just quickly, I'll just make a comment on this next question about oil and gas. So somebody's asking about the link between oil prices and capex plans on the oil and gas sector. So we haven't brought in Indrajit and Will to talk about oil and gas this week, but broadly the things that we've been talking about, there are strategic reviews going on the capex programs. We're seeing oil companies seeking to renegotiate contracts to get lower prices. So, you know, across the region, ADNOC, PDO, Aramco, trying to push down prices for their planned expenditure. And we have seen statements from Aramco, and I think ADNOC as well, about a review of capex plans for 2020, taking those plans down a little bit. Downstream probably more impacted than upstream at this stage, and perhaps a shift in focus to brownfield and OPEX spending rather than and delaying perhaps the capex project. So that's just a sort of summary of some of the connections we've seen between the outlook for oil prices and the oil and gas projects. I think the renegotiated contract is an important part of it. We'll come back to it in a coming webinar as well. But today we're going to focus mostly on the construction stuff. And we can come back to these oil and gas questions in the Q&A at the end. Okay, thanks, Ed. Nabil, if we could go to the next slide, please, and that one. No, it's the one on Chinese influence, please. Okay, thank you. Now, Colin Foreman, MEED Deputy Editor, wrote a story on MEED.com this week about Chinese influence in the Gulf growing. And I thought this was quite an interesting one to highlight because obviously there's a lot of controversy about the fact that COVID-19 originated in China, and there's political debates about you know, the exposure, the risks of globalization and manufacturing in China, and the lack of trust around transparency. So I think this is quite an interesting question. Colin, if you could perhaps, we've got 4 headlines that have all been published on MEED.com in the past 7 days, all about Chinese influence in the region. So I think it's quite interesting that you chose to write a commentary piece on this. What's your take?
Yeah, I mean, over the last 5 years, I've noticed that Chinese companies are becoming increasingly influential in the region. That's across all sectors, certainly on the project side, whether it be oil and gas, power and water, or construction and transport. And that's really become a lot more noticeable really over the last year, 2 years. And then there's been a lot of concerns about that from other players in the market. You know, are the Chinese, is the Chinese market share a threat to existing players? And questions like that have been asked. And then really this year, the questions changed slightly. We've had the issue with the new coronavirus, COVID-19, which the first outbreak was in Wuhan in China. There was issues there with initially with product and people coming out of China as that area of China was in a lockdown. And then there's been talk about, you know, whether markets should be as reliant on Chinese products in the future. What's the world's trading relations going to be like with China? And then, of course, in this region, with them becoming more and more assertive in the market, the question is the Chinese influence going to continue to grow? So I've really been looking for signs and indications of whether that is the case. And just in the past week, there's been a string of awards involving Chinese companies, which would suggest that growing influence is continuing, certainly at the moment. And really, they've been across a number of different sectors as well. So I think that's quite an interesting trend, but certainly one to observe in the future. I mean, the other interesting aspect of it is the political dimension to it as well. The contract that was signed between Saudi Arabia and a Chinese company to provide virus testing kits was done at the very highest level with a high-level government involvement. So I think that just shows that the political dimension and the high-level trading relations are still there, and I would expect that that's something that could well continue in the future. Just another interesting aside, just on trading conditions at the moment, which is a little bit of a fact but quite interesting, is the tanker order headline, which you see there, was for an LNG tanker for a client in Qatar with a Chinese shipbuilding firm. And that was a $2.86 billion contract that was finalized using virtual meetings. So that just shows how the world has changed over the last month. Very good. Okay, thank you. I think this is a topic we could perhaps go into in some more detail in a future webinar and on in MEED's reporting work. So but that's an important trend. Thank you. If we can go to the next slide, please, Nabil. Now, the aviation sector has been critical, really, for the GCC, and particularly Dubai, over the past 2 decades or longer. And it's also been the sector that's been hardest hit immediately by the lockdowns from COVID-19 and alongside tourism. So severe implications for the region. Neha, you've published at least 3 stories in the past week, which we've got on screen just now. If you could give us a couple of minutes just about where are we with Gulf aviation and what might it all mean?
Thanks, Richard. The outlook for aviation in the Middle East it just seems to be getting more and more bleak, unfortunately. IATA earlier this week said that more than half of the Middle East's aviation jobs, so that's 1.2 million jobs, face risk due to COVID-19. Now that's a projection that's been updated since the start of the month, when only 900,000 job losses were expected. So it really goes to show that the longer we have these lockdowns in place, the longer we have travel bans in place, the worse it will get for the aviation sector, naturally. There will also be significant losses in economic contribution. So just in the UAE, we can expect a GDP loss of about $23 billion due to the aviation sector's decline. In the rest of the GCC region, excluding Bahrain, this amount is $24 billion. So it really goes to show how much of a contributor in terms of growth the aviation sector has been in the UAE over the past 2-3 decades. And I think it also highlights just how worrying it might be for real estate owners in the region that are now probably thinking, is anyone going to come to my malls? Is anyone going to want to buy more property? So that knock-on effect is what IATA has really been highlighting, and it is a worrying trend.
Great. Sorry, maybe Murray, when he starts talking in the second half about real estate, might want to touch on that, because obviously Emirates is such a big employer in Dubai. I think you're right. But the other thing that just stood out to me from the comments you made, so broadly speaking, you've described across the GCC about $50 billion, just under, of lost GDP for the GCC. In the earlier slide we had about economic stimulus measures, broadly speaking, it was just under $50 billion in the GCC countries that have been pumped into the economy through stimulus spending. It's just interesting, I mean, that's two factors that sit side by side, the loss on one hand from aviation and the need for government propping up, and that kind of is a good indicator of the loss and the importance of it. I wonder, do you have any, what does this mean for the Maktoum Airport and Dubai's plans? I mean, can we say at this stage, we've obviously heard the Expo is being postponed because of the health risk and the sort of international situation, but in terms of infrastructure projects, can we read anything into this? Maybe Colin also has a view on this. But Neha, what's your thought?
Well, as I understand it, the discussions are still underway to expand Al Maktoum Airport, and this is something Colin will be able to talk to us about. Sharjah Airport's expansion is also proceeding. The bids have been received, as we discussed last week. So it appears that these sort of critical infrastructure projects will go ahead. But like Ed pointed out, we don't know if there will be any delays. It is not unlikely that things get pushed, you know, to later in the year or maybe next year, depending on how liquidity pans out. But again, I would defer to Colin for Al Maktoum Airport specifically. He's the expert.
Any quick comments, Colin, on that?
Yeah, I think for new airport builds, it's quite an interesting time at the moment. I think what you're seeing with aviation is that some of the flaws in the way we travel are being exposed by the virus. So I think there's an opportunity there for what you would call a next generation airport, which has got a lot less mingling of passengers before you get on planes, a more streamlined check-in process. There's definitely an opportunity for an airport that does that. I think that's something that new airports around the world have been looking at, and Dubai is no exception to that. So I think that's potentially an opportunity if Dubai can be one of the first onto the scene with one of these sort of next generation airports. On the flip side of that, okay. I think that the virus and the containment of viruses in the future could undermine the hub and spoke model and perhaps potentially favour point-to-point travel. So I think in some ways it's positive, some ways it's negative.
Okay. Okay, thank you. Now let's get on to the main section. Nabil, if we can go to the next slide. So Colin wrote a story about, based on, I think, a report from Savills about Expo's move into 2021 coinciding with the real estate revival in Dubai, and we can see the story in the link on the left-hand side. So I'm going to hand over to Colin and Murray. Murray is the head of Dubai for Savills, international property consultant, and has been, as I said earlier, has been in this region for 12 years, based in the UAE, covering Abu Dhabi and Dubai. So Colin, I'll hand over to you. I'll just invite people to submit questions. This is a great opportunity to sort of dig into Dubai real estate. I know it affects everyone, or a lot of people in the MEED audience. So please use this opportunity to send your questions, and we'll deal with them after maybe 10 or 15 minutes. So over to you guys. Thanks.
First of all, thank you very much for joining us, Murray. As always, great to see you.
Hi, Colin. Thanks very much. Hi, everybody. Pleasure to be involved, and thanks, Richard and Colin, for the invitation.
I think that the best place to start is really just ask you, for me personally, I think the seminal moment last year on Dubai real estate was Sheikh Mohammed saying that we've got an issue with oversupply. If you could maybe just talk us through what your view on the market was towards the end of last year and the beginning of this year, before the lockdown came in, just to give a bit of context as to where Dubai real estate was sort of pre-COVID-19.
Yeah, I think some of the trends that we witnessed over the last 5 or 6 years are very much in direct correlation with some of the graphs that Edward was referring to there earlier in terms of contract awards and contract handovers. I think the fact that the continuation of contract awards and new contracts coming into the market throughout 15, 16, 17, it clearly, looking back now, it was unsustainable, and the level of supply was flooding and overpowering the level of demand growth in the market. And what we've seen, which was not great for the construction sector and not fantastic for the development sector, but necessary for real estate market, was a slowdown in terms of new contracts and values and contracts awarded towards 2018, 19, and now moving forward into 2020. And I think coupled against some of the positive statistics in terms of transaction numbers, this is on the residential side of things, transaction numbers for 2019, for example, showed 25% year-on-year growth compared to 2018. And that was a major sign of positivity in terms of activity levels increasing by 25% year on year, where we had quite a lot of negativity in the market for 2017, 2018, where the market was clearly oversupplied. And again, running into Q1 2020, we'd seen very strong performance actually, particularly in January and February, pre anything to do with COVID, well, locally anyway. We'd seen 21% transaction levels up year on year for the same period. So considering that we had fantastic 25% growth for 2019 and again 20% compound growth for January and February, we feel it is very unfortunate timing now to have COVID hitting us at a period where arguably we're starting to see the market bottom out. We're starting to see the level of new construction and new projects launched soften considerably, as we saw in that Q1 bar graph that showed that Q1 2020 contracts awarded were down close to 60% compared to any of the last 4 years. And coupled with that, we'd seen particular growth in transaction levels. Now, unsurprisingly, for March and April, COVID has started to take an effect, and a very kind of artificial and immediate COVID-related effect to the market over the last 6 weeks has been witnessed at a point when the market was starting to find its feet and show a bit of growth.
And what have been they're strong growth numbers that you were referring to for the beginning of this year. What do you feel were the key reasons for that?
I think it's important to say that it wasn't all plain sailing. There was still contraction in values, in sale values, and prices achieved, rental rates. Despite the lack of activity, it was still a market adapting to the heavy level of supply that had come in. But it was clear that the bottom of any market, the first port of call has to be increased desire from demand in the market and increased activity, and that's what we were starting to witness. And I think if we'd had consistent, continued growth of transaction numbers set against an obvious drop-off of new projects coming to the market, then we were set for quite a positive time in the market over the coming 2 to 3 years. So I think a lot of that was down to just the general trend of the last 5 to 6 years, really since the announcement of Expo, where all of a sudden we saw quite an immediate hike of activity and expectation at the end of 2013. And it took until 2018, 2019 for some of that heightened ambition and positivity to actually work its way out the market. And we were just about starting to, like I say, find our feet and balance up that demand-supply relationship to show some growth in coming years.
And we're here in Dubai, we're coming out of lockdown easily in small steps this week.
Yeah.
What's your expectations for the rest of this year? And obviously this year's the outlook for this year's changed considerably, because of COVID, and then related to that, it's looking likely that Expo 2020 will now be held in 2021, pending a final vote. What's your expectations for this year and perhaps leading up to an Expo in 2021?
Yeah, I think there's still a lot of positive fundamentals in the market. You know, the handover of new projects and new contracts to be awarded are not going anywhere in terms of going back up the way or spiking. So in terms of a correction of supply, that's positive for the overlying market. I think what's very difficult to get a hold of is quite how transactional activity will perform in the coming months in rebound to COVID. I think what we've seen is, you know, to date for April, for example, you know, April has been the quietest month, unsurprisingly, for the last 5 years, the quietest month on record to date. We've still got 48 hours or whatever of business to go, but to date, it's been we've seen about 1,600 transactions in April so far, and the lowest month over the last 5 years was 1,900 a few years ago. So we have seen a considerable slowdown of transactions in April for obvious reasons. And I think some of that will run on into May as well. But equally, just within the last week, thankfully at Savills, we've seen a huge uplift in terms of inquiry levels and activity, just with the fact that the lockdown has been eased and people are able to carry out viewings again and get out of their house and start considering life beyond their own four walls and how to get through each day at a time. So I think a lot of the fundamentals that we've talked about driving towards a recovery and growth, they are still there. I think, you know, obviously the delay of Expo is a very painful issue at the moment for a number of sectors and overall for the market. We are not going to be enjoying the levels of incoming tourism and growth of GDP and additional spend throughout 2020. But I think we're all well aware that the world has its own battles to deal with in coming months. And I think we actually will look back in a number of years and hopefully we will see the potential delay of Expo as a necessary evil and in some ways an opportunity for us to make sure that we are preparing even better in a fashion to host Expo and make a success of it in 2021. I think it's a very positive measure that looks to be worldwide agreement to delay by 12 months and roll out in 12 months time, because something in the nature of a cancellation or an agreement that it would have been impossible to hold just now or at a later date would have been catastrophic. But I think in many ways a delay could still allow us to take optimal advantage of Expo if we are able to recover suitably from COVID in the coming months.
And we've talked quite a bit about supply, and we've talked about oversupply. What's your expectation for demand over the near term?
Yeah, I think we've seen demand quite heavily on the off-plan side over the last 2 years. I think that's an obvious balance where we're seeing such heavy level of new supply and construction and new development. Then a lot of investors have been looking towards the off-plan side of the market. I think what we will see is that start to level up in terms of the secondary market and complete product start to grow a bit. So, over the last 2 years, we've seen about a 60% off-plan balance compared to 40% of completed product sales. Now, I think we'll start to see that balance up as new off-plan product starts to slow down. End users start to come back into the market looking to buy real estate that they can actually own or occupy and either utilize or rent out themselves. We've seen mortgage changes in terms of now being able to allow 80% borrowing for first-time buyers as opposed to 75%. So I'm hoping that we will see a swing back towards secondary end user buyers that actually usually makes for more steady and a more reliable market rather than relying on such a high level of off-plan and potential speculator. And I hate to use the flipper term that was always the curse of Dubai 10 years ago, but making sure that the balance of sales is more geared back towards end users and completed product is a positive sign for the market. And I think the fact that we talked about activity levels being down during COVID over the last month, we've actually seen 76% of all transactions off plan over the last month. And that is clearly linked to the lack of being able to get out and view and see properties. And the market over this period has swung back towards those that are happy to inspect a future product via a virtual video or an online tour and a floor plan and make a decision there. So I'm hoping that as and when we come out and we're able to actually carry out viewings, we will start to see a soak up of current stock as opposed to a continued fueling and purchasing of off-plan and new development yet to be handed over and come to the market.
And Neha was speaking earlier about the aviation sector, and it's something we've discussed over the years, sort of things like logistics space, warehousing, and thrown into that, we've got other sectors as well, such as retail and shopping malls. And really this question of, you know, what's the future of real estate going to look like? Do you have a view on sort of big picture trends of different types of product, different types of development, maybe other sectors losing out as others benefit?
Yeah, it's definitely a big topic of debate at the moment, and there's really not one story fits all, because the sectors are so different, and some of them can gear up positively towards the sort of changing of the guards during COVID. Retail, for example, certain retailers have been going absolutely incredibly when you look at some of the growing e-commerce and online retailers, and some of the guys that are quite tech focused and quite futuristic have actually taken this as an opportunity to gain market share. And from a real estate point of view, you know, that has meant that demand for good quality logistics and warehousing and storage and well-located property that means that delivery can get out to homes quickly. We've seen, you know, an uplift and an uptick in demand for those. And then, you know, you counteract that with traditional high street or mall retail, as you'd look at in Dubai. And clearly, when you shut the doors of a mall for a month at a time, there is quite an obvious knock-on effect on demand for retail businesses that are running physical stores in malls, and it's almost been complete different ends of the spectrum. So I think malls will start to pick up. I think the challenge with malls in particular is that malls have, and especially in the Middle East, in the region, have been trying to move towards a social destination and beyond just the retailing. So, you know, we all have to, you don't have to look too far at any malls in Dubai to see a lot of the eateries, whether it be the sports facilities, the common amenities. It's about providing a family environment and an experience, you know, to go and spend the whole day rather than expecting people to drive and queue up and park and walk around something the scale of Dubai Mall or Mall of the Emirates just to go and shop in one or two shops. And the problem with COVID now is that, you know, people are going the other way, and they're not looking to mix. They're not looking for social experiences out with the house. So I think short term, it's clearly a real issue for retailers. And no matter how quickly we take our foot off the gas in terms of dealing with COVID, I think it will be a while before we are all back sharing tables and queuing in restaurants and mixing very closely to each other in the mall model. So I think that will need some definite tweaking. I think on the aviation side, again, you know, clearly aviation and hospitality massively affected by the lack of circulation of visitors and tourists. I think there's an element of, you know, the brunt of that will be short term and it will pass. But, you know, even from studying our Savills business in China and Asia, you know, the offices have now been back open for 6 to 8 weeks, and we're still seeing business revenues creep up towards 50, 60, 70% capacity, you know, with a view over the coming 6 to 9 months getting back up towards somewhere normality, which does paint, unfortunately, quite a bleak picture for the remainder of 2020 for those sectors that have been so critically and so badly affected. I noted an article just yesterday, for example, that suggest, I mean, the headline said tourism due to kickstart and reopen again from July this year, and the first line of the article said, however, this may be postponed to September. So it's very, very difficult to nail down these timings, and certain issues like that, like the opening of the borders and the opening up of the countries and the Emirates, are almost an on and off switch for these airlines and hospitality, and that's mirrored places like, you know, British Airways' announcement today that, having tried to hold off, they will be potentially shedding 12,000 jobs from a total of 50,000, which, for one of the strongest performing airlines over the last 3 or 4 years in terms of share price and growth, it's a sign that these problems are global and not just confined to any one region.
Murray, if I can just step in here, because we've only got about 10 minutes left, and we have a lot of questions. And there's one here that is about pricing, real estate pricing in Dubai, which obviously is a very sensitive issue for loads of people, rents and property prices. So the question is, you mentioned an increase in transaction levels in the residential real estate market in Q1 2020. Can you comment on the expected continued declines in residential pricing? And when do you expect the market to recover, as there are many homeowners that have lost equity? So just briefly, because we are tight on time, what's your view on the outlook for rents and other pricing?
Yeah, I think it's incredibly difficult to put facts and figures onto. It always is in Dubai, let alone when you're right in the heart of COVID. But I think one thing's for sure is that it's not a single tiered market here. It's not one recovery rate or one price growth fits all. I think what we always see in Dubai is a return to performance of the most solid types of areas and quality of buildings and offerings in the market. And I think, to use some of the typical examples, we've actually seen very good, strong growth in Dubai Marina. There you have an area it's got great amenities. It's a popular location to live in. The level of supply and the level of oncoming stock to Dubai Marina has definitely slowed down. There are some, still along the walk and the beach, there are new properties coming on. But in terms of, waterfront properties at Dubai Marina, definitely the rate at which new units are handing over has slowed down. And as such, we've seen increased demand. We've seen signs that buyers think that the property values are not going to drop considerably over a sustained period. And I think we're seeing the same in certain other areas. Old Town Jumeirah, there's only so much in terms of new development going on there. We're starting to see better performance in areas such as Emirates Living and places like the Ranches. Some of these places where there's not a huge amount of new supply coming on and demand is actually starting to show growth and starting to show better performance in the market. So timing this is tricky, but I can say that having gone in the wrong direction for a few years, I think things are moving in the right direction. And I would like to think that probably at some point next year, we will start to see things moving upwards in the right direction.
Okay, and do you think that the cuts in interest rates, I'm guessing that people will hope to get lower prices, better deals, where they've got a longer term view. How much impact will the cuts in interest rates have on real estate sales? Is that important?
If you'd asked me this 2 months ago, I would have told you that they would have had a very severe positive effect in the market. Now, the major disappointment in this is that they were announced basically concurrent with the introduction of COVID, and as such, that's had a double effect. That's had an effect that the target market are sitting out of the market. They are not inquiring about taking up these opportunities because, as I say, the inquiry levels for first-time buyers and end users has slowed down considerably because of COVID. And also the ability for banks to operate properly in terms of rolling out new product and carrying out a lot of their sales activity and a lot of their relationship building that they do when they have this fantastic opportunity to talk about lowered interest rates and higher LTV ratios came right at the point where they were almost exactly at the time that they were closing their doors and they were all getting locked down in their own personal places of habitat. So the problem is that the COVID has put a complete dampener on these announcements. But again, underlying, I think, potential for those movements and those measures by the central bank are something that as agents and as commentators in the market, we've been crying out for a long time. And I think that disregarding COVID effect and as and when that starts to dilute enough, I think they will be positive markers in the market. And we're already seeing that with some of the inquiries that are coming through this week post-lockdown. The
inquiries you referred to this week, is that pent up transactions that just people had intended to go ahead with and they've been unable to, they're coming back? Or is it people seeing perhaps an opportunity to get in while the prices are low?
Yeah, I'd welcome anybody to give any more certainty than all of our board in trying to work that out. It's tricky. I think it's probably an element of both. I think we have to be honest with ourselves. If we see increased activity over the last 3 days, it's because we've had so little over the preceding 3 weeks that inevitably people have just decided to either pick up the phone or start processing those decisions that they've made or those actions that they've taken over those 3 weeks. So, I mean, we saw an immediate bounce back, for example, in the amount of valuations that we were instructed on Sunday, on our first day back in the office. And, you know, our first reaction was fantastic. We've had a huge influx of new business on Sunday, but let's not assume that this will be the case for the next 10 days, because there must be some element that, you know, that there will be an artificial or a backlog of rebound that shows up in the few days. And is that sustainable? Is it a sign of the market being back, or is it just a sign of leveling up for the lack of activity for the last 3 weeks?
And there's a couple of questions in here about liquidity, and we've talked about contractor liquidity over the past few sessions in the region. You know, delayed payments and lack of new projects and competitive tendering. So there is a question here for you, Colin, about how vulnerable are contractors at the moment. Can I extend that to you, Murray, and ask about real estate developers and property developers? Because if they've been borrowing to develop and they're not getting the sales in, they must be under a lot of pressure as well. So perhaps, maybe Colin, if you want to comment on the health of contractors at the moment, and then Murray, can I ask you that about developers?
Sure. Yeah, I think contractors are in a very difficult position at the moment. They've got a client that wants lower pricing and is struggling to move ahead with projects. They're wanting discounts, and then at the same time, as a contractor, you've got costs increasing as your ability to operate is hampered by the various lockdown measures and social distancing and things. So you've got a cost base that's going up, and you've got a client that wants cheaper pricing. So I think contractors are really stuck. And then thrown into that, there's prolongation costs and additional costs that you may or may not be compensated for. So I think contractors have got a real challenge managing that risk. But the old maxim of contracting is not about building things, it's about managing risk. I think you've got to do some real hard work managing that over the next few months.
Okay, and Murray, on the real estate developer side, how worried should we be about the developers?
Yeah, I think that, you know, what Colin said is very much mirrored between contractors and developers. You can normally tell that when contractors are having a good time, that's because the developers are too, and vice versa. And I think, you know, I don't often, you know, single out names, but it was quite clearly a public debate between DMAC and EMAR recently about the fall in sales numbers from DMAC and the level of supply that had been continued into the market from EMAR. And I think that is, you know, is a significant sign, and it is something that we have been seeing for some time, is that the levels of supply have just not been sustainable. And at certain points, some of the biggest developers that you've seen with brands up all around the city and continuing to launch multiple projects off plan, you know, it was only sustainable for a certain amount of time. And I think we've seen the last 2 or 3 years, it's been incredibly difficult for smaller scale private developers to keep a foothold in the market and make their margins and sell product, because some of the larger scale, better known names have been bringing such a high level of supply to the market. And I think we're starting to see things level up and correct on that front. And unfortunately, for me to be able to paint a positive picture to the end user market and the buyer market, and for values to go up and rents to go up, that needs to be triggered by a certain element of pain and discomfort on the other side of the fence from a slowdown in terms of contracts awarded, new development, stock money being made by developers to level up the market.
Okay, thank you. Now we're getting right to the end, so there's a couple of questions I'll just answer quickly. We have 2 or 3 people asking about the GDP growth outlook for the region. So IMS last week published its World Economic Outlook report for the MENA region, 3.3% contraction in growth, GDP growth in 2020, and that is based on a recovery in the second half of the year, that we get through the peak in cases in Q2 and things pick up quickly in the second half of the year. If it extends if the recovery is slower and extended to the fourth quarter, that would take another 3% off growth, so a contraction of up to 6%. And if it goes further into 2021, 8%. But let's say on the first model, the recovery in the second half of the year, so 3.3% decline in growth in 2020, followed by a rapid rebound of about 4.2% in 2021. So that's the IMS numbers. Basically, a deep recession this year, a dip this year, and then a rapid rebound next year. And there's different percentages in different countries, so that's the general pattern. We've also had a number of questions, which I'm not going to be able to answer now, about the outlook for projects, the longer term outlook, 3 or 4 years, and also specific sector outlook. So for next week, in this time slot, Ed James is going to take over he's going to do a MEED Projects market presentation for the full slot. And so I will hand over those questions to him, and he will give chapter and verse on the outlook for projects, and be able to take your specific questions about that. So tune in next week for those project market outlook questions. Nabil, if we just go quickly to the next slide, because there's an important event tomorrow that I just want to tell the audience today about. So we mentioned earlier on that a lot of clients, particularly in the oil and gas space, but across all sectors, are looking to renegotiate contracts, to push contractors' pricing down. And this has obviously got a number of questions. Firstly, what are the legal implications for contractors? How do you respond? But also, is there actually any more room to squeeze your prices down? Because we've had 5 years of very tough trading conditions for contractors, as Colin and Murray were both just talking about. So there are some very technical questions from a legal point of view, and then commercial questions. And so we have Susanna Newbold, who is a partner at DLA Piper, the law firm, and Chris Seymour, who's the Middle East chair for RICS, Royal Institution of Chartered Surveyors, and the managing director of McDonald, along with Mohammed Shuli, the head of global contracting finance from Mashreq Bank, and Colin will be part of that as well. So that's tomorrow at 11 o'clock, and it's about renegotiating contracts. I think that's quite important, and you can get your questions in there. And that's part of the Mashreq Connect series that MEED and Mashreq have been working on for quite a long time. Yeah, so that's tomorrow at 11 o'clock. I recommend it. And then final couple of slides, Nabil. MEED is updating all of its research reports about the impact of coronavirus on the market. If we can show the next slide, Nabil. We've just published one on Saudi. We've got one that also just out on MENA projects. We have one on Kuwait and one on renewables, and next week one on Iraq. All of them have been updated, complete market reviews, granular detail on projects and clients, and updated for coronavirus. And Ed has published a series of PowerPoint presentations on all the different markets across the region as well. So have a look on MEED.com, MEED Projects, to find out more about those, or you can email myself and Ed on the details shown on this slide. So we're out of time. I just want to say thank you very much to Murray for his fantastic input, his expertise, and his time. So Murray, thank you for joining us today.
Thank you.
Thank you, Colin and Neha and Ed, of course, for your hard work putting the slides together. And finally, thank you to everybody who joined us. It's been a great turnout today, a large number of people joining, and loads of questions. I'm sorry we couldn't answer them all. We will try and reply by email if possible. But stay safe. We're nearly through this thing, and we will keep going as long as there's interest in these webinars. And enjoy the rest of your week. Thank you, everybody.